Good morning, good afternoon, and good evening, everyone, and welcome to our 7 Investing podcast today. I'm 7 Investing founder and CEO Simon Erickson, and it's our mission to empower you to invest in your future. 2022 has been a tricky year for investors. It's been challenging. We've had supply chain issues. We've had interest rate rises. We've seen inflation. We've seen COVID. We've seen a whole bunch of different things, but it does not mean that there are not opportunities for equity investors out there. And in fact, they're not just within America's own borders, they're also international opportunities as well. And that's why I'm very excited to welcome to the podcast today, Comgest. Comgest is an independent global asset management firm that's based out of Paris. They manage more than $35 billion. With us today is their CEO and Chief Investment Officer, Arnaud Cosserat. With him also is his portfolio managers, Rick Mercado and Richard Kay. Arnaud, welcome to the program. Thanks for being part of the 7 Investing podcast.
Hi, Simon. Thank you very much for having us.
And Rick and Richard, thanks for being here as well. Good evening to both and good afternoon to both of you as well.
Thank you, Simon. Pleasure to be here.
We've had, like I mentioned, quite an interesting year for investors this year. I think that most people would consider 2022 to be challenging. I want to talk about several of the opportunities that actually are out there for investors. But perhaps before we start, since we do have you on the show, everyone might not be familiar with Comgest. Arnaud, could you kick us off by telling us a little bit about your firm and the types of companies that you like to invest in?
All right, thank you, Simon. Yes, Comgest is an asset management company born 37 years ago. We manage $35 billion in long-only equity. We're investing in all equity markets worldwide through an investment platform of 50 experts, all united by the same investment approach that we call quality growth investing. It's a very long-term and concentrated investment approach, around 30, 40 names only, very low turnover, average holdings over more than 5 years. And I would say there are two differentiating factors when you look at Comgest. The first one is our investment beliefs and strategy are very clear, tested and proven for more than 3 decades now. And it's with the same products, the same approach, and the same people behind the portfolio, sometimes 3 generations of people overlapping. So it's been all very, very consistent. It's all about fundamentals prevailing in the long term, the fact that we focus on a few companies that are outstandingly delivering sustainable growth in the long term. And the way we generated outperformance for our clients over the last 3 decades was, first of all, by doing time horizon arbitrage, meaning taking advantage of short-term market efficiency to build long-term position in companies in the long term, and then leveraging their power of compounding. So a company that can grow double digits over an extended period of time is gold. And as a result of that, we're very selective, very long-term. We keep exposure to companies for 5, 10, sometimes 20 years. And the reason why we can do that is second big differentiating factor for us is we have broad partnership. The broad partnership is a cornerstone of Comgest because it enables us to be who we are, what we do, and to do what we do. We have 210 employees, 170 are shareholders. They buy shares in Comgest every year with their own money. Sometimes it takes them a lot of time to build a significant stake in the company. And being long-term, is a luxury that you can only afford if you're independent and if you're incentivized to think long-term. And I think the broad partnership scheme is kind of a skin in the game. It incentivizes us to take extra focus on the long term and be very, very demanding when it comes to selecting the right lower risk companies, high quality companies we're focusing on. It's also a great asset because it fosters a culture of collegiality within the company, and everything we do is teamwork. And that's Comgest.
I love it. I love the long-term focus. I love the time arbitrage that you mentioned. But gentlemen, I have to bring up, it's been an interesting year, right? We are certainly fans of long-term investing for individual investors here at 7 Investing. But it seems like you can't get past the headlines that are flashing in front of our faces every single day, right? Inflation, interest rates are going up, the Fed, everything else. How do you all think about the macro right now? Is this influencing the investing that you do? Is it influencing the types of companies you're looking for? I'll open that up to whoever wants to answer it first, but I would like to know how the macro impacts you all as portfolio managers or chief investment officer.
So I'm sure Rick and Richard will have a lot of examples, but we are bottom-up stock pickers first. We focus on quality companies. I mean, we are more interested in companies that are well protected against exogenous factors. And of course, no business operates in a void, but some are far more autonomous than others, notably because they create market of their own or through innovation, for example, or because their end customers are not too dependent on the economic cycles. For example, if you take the European portfolio, Novo Nordisk is the world leader in diabetes. They've been selling a lot of new products over the last 30 years and going from one generation to the next. Two clients are far less sensitive to the economy in general because it's a must-have product. You need to treat your diabetes when you're faced with this type of consideration. And I'm sure Rick and Richard would like to share with you this and through a few examples. Of course, the change in the economy and the monetary aggregates have a short-term market impact on the way the stock behaves, but they rarely have an impact over 5 or 10 years. And at the moment, you're right, we're talking a lot about inflation, and certainly we will talk more about disinflation in 2023 or 2024. Nobody knows at what pace disinflation will happen. And we don't know what is the final destination. We don't know at what cost it will have on the economy. We don't know if we're going to have a hard landing, a soft landing, or no landing at all. Certainly, the final destination is very much impacted by the same deflation stories of the last decades. Demographics, productivity, poor productivity. But at the same time, there are some new midterm challenges like deglobalization, for example, in a multipolar world, and the need for economic blocks to be more autonomous, and the ecological transition, which will profoundly transform our industry, the way we produce, the way we travel, the way we consume. And it might be more inflationary. Look at the Inflation Reduction Act in the US right now. That's an example of that. So, but back to Rick or Richard, I'm sure they will have a lot to say about that.
Yeah, it certainly is interesting times. Like we're grappling with pandemic, with inflation, recession, stagflation, lockdowns, pretty much everything that you can name. What I would say though is that it's often in times like this that you really do get your buying opportunities. So I might step back and highlight when it comes to the quality growth investment philosophy. If you think about a recessionary environment, quality tends to outperform. Your stocks are typically more economically resilient. They tend to have net cash positions, so they tend to do quite well in those sort of environments. In an inflationary period, there's been some good research that has been done in this area. And I think it's 6 out of the last 8 inflationary periods, quality has actually outperformed. And if you overlay that with a valuation measure, it's 7 out of the last 8 periods it's outperformed. And that's because these companies, they're typically asset light, they have high margins, they have strong ability to pass on inflation to their end consumers. Where the philosophy is having a little bit of a tougher time is more around the rising bond yield environment. Certainly in a rising bond yield environment, the growth part of the equation certainly does suffer, at least in the short term. And yet, when we think about this, we get a lot of good opportunities here. So, for example, the global fund, it's been running for 30 plus years now. And to your question, does this actually affect the way that we go about investing? It pretty much doesn't. Like whether it's an exogenous shock, a pandemic or so on, the game plan pretty much remains the same. We follow a small amount of companies in a lot of detail. And quite often what happens when you have one of these exogenous shocks is that the valuation dislocates away from the actual fundamental outcomes. And the last, I'm guessing Japan might have just scored just then.
Something happened in the World Cup there, Rick.
But yeah, so if you look at the last 3 years, for example, obviously it's like a number of cycles compressed into one. And yet in that time, we've been able to buy stocks that we've been waiting for, sometimes for over a decade, to buy and see that valuation come into line. So HDFC, it's a mortgage provider in India. That's a great example for us. At Comgest, we've covered that name since 2009. It made its way onto the global universe, so the list of companies that we would like to invest in at the right price, in 2014. We watched that company while it was invested on in the Indian portfolio. We watched them navigate through different economic environments, different competitive environments, systemic shocks, interest rate changes, and so on. And the company delivered extremely well. So when the pandemic finally hit in 2020, the market sold off dramatically. And yet we had a lot of conviction around that management team, their ability to execute, and yet valuations were back down to trough multiple levels. So in one way, it's like you're able to capitalize on this very powerful research platform. Because of that partnership, we can be very disciplined, we can be very patient, and yet when the times look the bleakest, we're able to find alpha producing opportunities that will hopefully deliver performance for our investors over the long term.
Richard, anything you'd like to add? Those were some fantastic answers from Arnaud and your colleague Rick there.
Yeah, thank you ever so much, Simon, for that. And your questions really strike a chord. I cover Japan. You just heard Japan doing very well in the World Cup. I apologize for the background noise there. It's funny because the World Cup, in a sense, is Japan's story in microcosm. You've got a team that's not playing a sport that's familiar. They've come from nowhere. They've beaten a lot of people that have been doing this game for 100 years, and they're doing amazingly. And that's kind of Japan's story. If you'd gone to Japan 10 years, 20 years ago, and you said, hey, I want to invest in growth companies, people would have laughed at you because Japan hasn't had an awful lot of growth for 10 or 20 or 30 years. We've had slow growth. We've had inflation, as you mentioned just now. We've had lack of resources. We've had 3 nuclear-armed neighbors and no army of our own. We've had earthquakes. We've had tsunamis. And Japan has still grown. And you've still had companies in Japan which have actually performed better as share prices, even in dollars, than an awful lot of the S&P. If you look at some active funds, and we hesitate to say, if you look at our own active fund on Japan, you can see we've beaten a lot of world indices, including the S&P 500, quite consistently over many years, even in dollars. And how do you do that, even if you're not in a growth economy? The reason is what Rick and Arnaud mentioned. You invest in companies, not in a macro story. We invest in, for example, one of the world's biggest diagnostic medical companies. It's a little company called Sysmex, comes from my wife's hometown, where they figured out how to do blood testing more quickly and more accurately than anybody else on the planet. And they're now the world's biggest blood testing company. So when Americans need to get diabetes related blood checks, when Chinese, who have, as you know, a major dietary change problem right now, need to go get their blood checks, they use this Japanese company. And we have a company in another portfolio, exactly the same area of Japan, the west of Japan. They make sensors that are used to measure curvature on car hoods. They are used in the design of semiconductors. It used to be a small company. They don't say an awful lot. During our tenure, the company's gone up 7 or 8 times. That is a company, Sysmex, also the blood testing company, is something that has nothing to do with a macro story. It has to do with the competitive spirit of a specific group of people who want to beat the world in their specific field, and they don't care about everything that's against them. And Japan, because of its context, is very good at making companies like that. And our job at Comgest is to find those companies. And that's what we try to do with our fund for the 15 years that we've run it, Simon.
I do want to talk about several of those industries, some that are cyclical, some that are less cyclical. You mentioned healthcare. I do want to talk about semiconductors here in a minute. I would like to talk a little bit about the European consumer discretionary companies. But before we jump into that, I would like to ask just very briefly, just a very quick question, is you have such a global team, Arnaud. You have, even on this call, in Japan, yourself, I believe in Europe and all over the world. Can you talk just a little bit about perhaps the culture of the different regions and the portfolios that you are constructing? Is there a preference that guides the capital allocation strategy of companies in different areas? What I might mean is, does certain areas of the world prefer to pay out higher dividends, share that out in cash with its shareholders, versus, of course, a lot of us in America know the Silicon Valley mindset of plow it right back in and step on the accelerator and go for the growth. In addition to being an interesting macro, like we just talked about, could you perhaps give our listeners a bit of flavor on the different regions you are investing in and the preferences of investors in those regions?
Mm-hmm. We have 6 teams of 50 investment experts that cover all markets worldwide. So we have a global team, so the global and global emerging market teams. We have an Asian equity team that is based in Hong Kong since 1994 and in Singapore. We have regional teams, so like Europe and Asia. And we have also a country teams. So we have a Japanese equity team based in Tokyo. Richard is based over there. And a US equity team that is based in Paris, strangely enough. We're not in the US. And I mean, it's interesting. It's an interesting way to manage from a remote location, the US. Sometimes it's good to be away from the noise and focus on, to help us focus narrowly on the long term. We work hand in hand because we address the same sectors most of the time. We're looking for high quality companies. That means companies with pricing power, with innovation, with creation of through strategy of their own market, their own growth and sustainable growth. So we have, of course, a preference for high value added type of businesses like healthcare, like tech, software, retail, consumer. And we all share data among the 50 of us in a very collegial way. And of course, I would say the one who is better placed to ask you to answer your question about where do you allocate capital is the global team, because they are the only one who manage the global portfolio. Each team manage different portfolio: Asian equity portfolio, Japan equity portfolio, European equity portfolio, and Rick is the only one who knows the difference between all those different allocations. Rick.
Thank you, Arnaud. Yes, certainly. So again, the philosophy is very much focused on growth. So similar to your sentiments about the US companies, Simon, quite often the companies that we're investing in, they are often reinvesting it into those growth opportunities. We want to see them doing that because it says to us that that secular growth theme, or the opportunities to keep increasing returns, keep getting market share, and so on, that continues to take place. So we haven't seen too much differentiation, at least between the stocks that we cover in close detail, whether they're in Japan, in the US, China, and so on, from that perspective.
And the truth is, we're looking for global leaders, and most of them. I mean, we have a few domestic companies in a few regions, but we have a lot of international leaders. And it happens that they have a Japanese passport or a European passport, but it doesn't matter. They're still very global companies with global footprint.
Let's talk about some global companies that require a lot of capital. That is the semiconductor industry. This is a capital intensive business. You know, we mentioned, I think, Rick, you mentioned just a little while ago about an asset light model. This is not typically an asset light model, at least for the companies that are manufacturing semiconductors. This is a very cyclical industry, as we already know, but it's also one that produces very, very high returns, and it's very, very hard to compete against some of those fabrication facilities that are global, of course. And then, of course, we've got the designers, right? We've also got the NVIDIAs and the AMDs of the world that are producing the world's most complex and complicated chips. Maybe I'll just open it up and ask you all what you think about the semiconductor industry. Is this of interest to you, being that it certainly has seen its share of valuation multiple contraction this year?
Yeah, right. It's at the center of many things in our life. Actually, it's every aspect of our lives requires semiconductors, internet, PC, video games, and now we speak through. Thanks to a lot of semiconductors, it's one of the most globalized supply chain as well. With there is a lot of fragmentation due to the specialization, the rise of a specialization model, where you produce somewhere and your IP somewhere else, you know, and so it's very much impacted by globalization, deglobalization, and geopolitical changes. And it's in the race to ensure the path towards net zero as well. In the race, it's a formidable solution enabler. Without components, we couldn't do anything. And you know the whole thing about the Moore law. I mean, every 2 years, there is this number of transistor on your integrated circuit that doubles and enables far less power consumption, better speed, etc., etc. So this law is still untouched. I mean, it's been verified since 1965, and it gives rise to a lot of opportunities for us, be it in the integrated device manufacturers, the fabless companies, or the foundries, for example. One company that is very dear for us in Europe is ASML, which is a worldwide leader in lithography, which is the lithography, the art to print semiconductor on a silicon wafer. It's a monopoly. company. It's a company that has a monopoly on the next technology, which is called EUV, extreme ultraviolet. It's we're talking about here about 20 to 30 years investment in R&D, and they are the only show in town. So it's one of the biggest positions in our portfolio, and it's less cyclical than the market. Maybe we'll come back to the market cyclicality that has changed over time. Maybe why is it less cyclical? It's because they sell a must-have product for the next to reach the next nodes, the next miniaturization level in the industry, and so and there is a long waiting line to get their product. So if TSMC steps out of the line, they need to come back later, and so they are far less dependent on cycle than companies themselves.
Yeah, and you are absolutely right that it is a capital intensive industry, but quite often that is where they derive their competitive advantage. So TSMC, as Arnaud was speaking to, they require so the run rate has been $40 billion per annum. So just think about being able to replicate that sort of manufacturing. It's almost impossible for a new player to enter the industry, put up that sort of capital and catch up on that IP and that scale advantage that they've already accrued. So that's quite important to us. I think it was BCG, they recently put out a study, and it said that if a country wanted to replicate a supply chain that TSMC has in Taiwan, locally, it would take about $1 trillion. So we're talking absolutely phenomenal, large amounts of money here, which pretty much, it gives us a lot of conviction around that competitive advantage standing for a long time. The second point that you asked about was the cycle. It certainly is cyclical. Again, we are very much focused on the long term. So I think at the most recent ASML Capital Markets Day, they said we're on track to being a $1 trillion industry by 2030. And you think about that, the drivers behind these long-term trends, they're mega trends, and they're still very much in place despite having this short-term readjustment. So things like the shift to electric vehicles. An electric vehicle requires 2 times as much content as an internal combustion vehicle. The shift to 5G requires 4 times as much content as a 4G base station in terms of volume and content within it, and even renewable energy. So 1 megawatt of solar power capacity requires 4,000 euros of semi content, and 1 megawatt of wind power capacity requires 3,000 euros of semi content. So all very good numbers, and in our view, very much moving in one direction despite these short-term machinations. One of the other things that we like to also point to is that Richard spoke about the phenomenon in Japan, for example. We quite often get these overlooked companies, so amazing companies with tremendous market positions, which generally don't garner as much attention on the global investor base. So Lasertec is a name that we like there. It's currently on our watch list, currently owned by Richard and their team in Japan. They have 90 to 100% market cap positions. They're not generally well known outside of Japan. We were able to spend 3 hours with them in Japan a couple of months ago, but that's a tremendous company, that I know Richard knows in a lot of detail as well. So a lot of opportunities, a lot of short-term noise and uncertainty, but long-term trends very much intact.
Great points, gentlemen. This is certainly, ASML is a fantastic company. There's no doubt about it, with the backlog that they have. The extreme ultraviolet, like you mentioned, $150 million per machine, 350 when they get the high NA numerical aperture, new ones out the door this next year. No doubt about that, a fantastic company. And then you also mentioned Taiwan Semiconductor, TSMC. My goodness, what they've built, over the past several decades is certainly incredible. And now, of course, producing the most complex chips for the entire world. When we talk about semis, I have to bring up the controversial question, though. And you all already know where I'm going, which is the geopolitical question. This is so important that there are now governments getting involved with the business and telling some of these companies where they can and cannot sell their products. ASML was brought up earlier. We know that it's on the exempt list for you cannot sell the extreme ultraviolet machinery into China based on the US patents that are within some of those machines. Taiwan Semi has got its own geopolitical tensions with their relationship with China and Taiwan. And we know that they're now building a $20 billion fab right outside of Phoenix, Arizona, here in the United States. Enter Intel as well, one of the integrated chip makers that's doing design and fabrication all under the same roof or the same corporate umbrella, which has now just been pushing its own design capabilities and, of course, opening up its foundries to producing those for others. So my question is, when you're looking at semiconductors, fantastic business, long backlog, very capital intensive, hard to compete with these companies, but there's also geopolitical risks. How do you assess those when you're allocating actual dollars and cents into these companies?
Here we're talking about tail risk, of course. It's let's say a known unknown, because we're talking about a China invasion of Taiwan. Of course, if this was to happen, I think the semiconductor chain would not be the only one hurt. I mean, it would be a massive crisis with impact far beyond the industry alone. Think of all the US or European companies doing business with China. I mean, that's so. As far as a company like ASML is concerned, it would be absolutely essential for any other companies to rebuild a capacity elsewhere in Europe. I mean, you were talking about the plants in the US or in Europe. They would have to accelerate those plans. Why? Because I mean, we all know that Apple chips are all shipped. I mean, all these channels from China, and they're all produced in Asia. So there wouldn't be any Apple phone anymore anywhere. So I know that they've already contingency plans to rebuild some capacity somewhere else, probably in India. But it's right in the moment where as we speak, that they're trying to react. It takes a lot of years to rebuild. So I think somehow it would be, of course, a big issue for this sector, but it would also give a lot of opportunities for some of the companies in this sector.
I mean, very much along Arnaud's observations there, and picking up on Rick's observations earlier, the semiconductor industry inevitably is a global industry because the products are global, and it's becoming less and less an issue in a sense where the things are made. You yourself mentioned, Simon, if TSMC is scared about being in one island in the middle of the sea, it can build fabs in other countries, including the US, including actually in Japan. And companies like ASML provide the enabling technology across the world. Rick mentioned we have a number of these similarly indispensable companies in Japan. They're often slightly less known, but they're just as profitable, and some of them actually have had even more spectacular growth from a lower base because of their exposure to only the most leading edge areas of semiconductor technology. And again, they are shipping globally, and they understand the China risk, but they're able to calibrate it very well. And some of these companies that we speak to even now, when you raise the China question to them, Rick mentioned a company called Laser Tech that is involved in miniaturization inspection. They've said, well, actually, yes, we have something like 4 years worth of orders backlogs, 4 years. And that includes all the China risk and everything else you could think of. We're still very comfortable in our outlook.
Great point.
Yeah, it is certainly a good question though. Like if you look at the global portfolio, we were at about almost 6% exposure just to TSMC at the start of 2021. And over the course of 21, that came down to about 450 bips of exposure. And then in 22, we reduced it even more so to about 350. Certainly, when we first began reducing it, it was more to do with valuations rather than geopolitical risk. But certainly that geopolitical risk has featured in our minds. From a bottom-up perspective, we love the company. We would love for it to be a 6% position again. And yet, the last 5 years has certainly taught us a little bit of humility around. There are certainly these big tail events that wouldn't seem like they should be the course of action to take place, and yet certain things have taken place. So we do exercise some humility, and there are certain things like politics we don't profess to being able to see into a crystal ball. Now that said, we do have a phenomenal team in China who are based on the ground. They get to travel around that country even when it's in lockdown, and we do very much, at least the global team, rely on their insight, both from a cultural perspective, a regulatory perspective, political perspective, and so on. There's been occasions in the past, like the online education center. We've never been invested there. It was wasn't even in our universe. When the market was quite surprised by what transgressed in that industry, our colleagues kindly pointed out that 2 years ago, the government had already flagged that that was not an area that they were positive about. So having that on ground insight is certainly an edge for us that we rely on quite keenly.
How about risk mitigation, Rick? Can I ask you just a bit, when you're talking about companies that have such backlog in place already, does that diversify away some of the risk of such a cyclical industry that the semiconductor industry typically is? Are you diversifying away some of that risk with the ASMLs or the Taiwan semis that have such a long backlog in place?
Yeah, certainly. So what we do like about the ASMLs and the laser techs is that there is a long lead time. The backlogs are in place 4 years, as Richard was saying, for laser tech. I think it's 1 year for ASML. That does give us some comfort that even if there was a geopolitical situation, these companies would be somewhat buffered behind them. At the same time, being realistic, they're all going to be impacted somewhat if there was to be one of these extreme situations to take place.
Certainly, yep. Let's talk a little bit about the consumer. It's been fun talking about chips, but let's talk about what the consumer is doing out there. We've certainly seen a lot of inflation here in the United States. We've seen interest rates going up, and that's kind of put a little bit of a press on financial services industry and consumers' pocketbook. Is it the same in Europe, Arnaud, or is the European consumer also feeling the press of the macro economy right now?
Yes, of course. We're seeing conflicting elements. On the one hand, you see a lot of companies passing over inflation to end clients, and the consumer is in the first line for a lot of rise in prices. Energy, of course, is a big thing. I mean, we're talking about a cost of energy that is 5 to 10 times above the normal. But at the same time, we're talking about markets where, like the US, there is a level of employment that is pretty high, and that means that as long as the unemployment level doesn't rise, people still have enough leeway and enough money to pay for goods. So I would say it's at the moment we don't see any big evidence that there is a big recession somewhere. I mean, of course, Europe, in case of recession, will be in the first line, essentially because of the energy costs. And we still are waiting for those signs. When talking about consumer, companies in Europe, there are a lot of things to say because, like everywhere in the world, in Japan or in the US, there are a lot of companies that sell products that are very linked to the history of the country, the culture of the country, how they've developed over time, competences. And of course, we have a great luxury good, background in Europe. We have fantastic luxury good companies like Hermes, like Louis Vuitton, and others. And those unique brands, unique companies have a few century legacy, behind them. It's very difficult to replicate, and their consumer have a very low elasticity to price increase. And actually, those companies have raised their price by 5 or 10% every year in the last few years, and actually the demand has not changed. So that's one of the main unique position in a consumer good, discretionary consumer goods that we have in the portfolio. I mean, think about companies like Ferrari as well. Ferrari is a unique company in its own, and it's continuing to sell very well. Actually, they had to cut the waiting line because they couldn't deliver products on time. It's a bit like the Hermes bag, the Kelly bag, which suffers 2 years waiting line, for consumers. And at the other end of the spectrum, we have the low-cost textile companies, the fast retail companies, like we have a few ones like Inditex, like Primark, like H&M. And those companies are selling to very cheap products. So they benefit also from time to time from the crisis, because when there is a crisis, people tend to buy cheaper goods, and they like the fast retail companies for the reactivity to trends, but also the fact that they're selling articles with price points of below €10, for example. So that's the two examples of company that can withstand a crisis at extreme extreme position in the range.
Yes, indeed. H&M, though I might say that, and Ferrari might be one of the most fun delivery jobs to have in the job. When you're delivering the car to the end consumer, that might be one of the best jobs to have globally. Ferrari and H&M, two great ideas. Rick, any thoughts on the Southeast Asian consumer or the Japanese consumer right now?
Sure.
Sorry, Richard. I should say Richard. Richard's the one in Tokyo, right?
Yeah, let me go with that. Thank you, Simon, very much. The Japanese consumer is surprisingly resilient, similar to Arnaud's comments on the European consumer, perhaps maybe different to perceptions. Remember that Japan's inflation rate is still very mild. It's about 3% only, and most of that is thanks to imported oil. It's certainly not a domestic demand-driven story. Remember that Japan's the only major developed economy with a significantly accommodative monetary policy right now. So we have a central bank that does not run away, raise interest rates, is very anxious to support whatever recovery we can have in Japan. And remember that Japan is also going through its post-COVID sort of period of young love, if I may say that, people coming out again, enjoying themselves again. And it's doing that something like 9 months later than the Western world, because Japan is just a more cautious country. And so all of those things actually make Japan's OECD forecast for next year, I think, the highest in the developed world. Japan will be the highest growth economy among major economies. The figures are not big, but the relative status is nice. And against that backdrop, showing off the consumer in Japan is doing fine. We have high-end offerings similar to Arnaud on Europe. They're perhaps less well-known companies, and they're less valued because of that. But they're great opportunities because they tap the exact same opportunities. High-spending, resilient consumers who want distinctive luxury brands like Kose, K-O-S-E. Some of the high-end offerings that we have in the cosmetic space, like a company called Polar Orbis, which offers high-end skincare, anti-wrinkle ointment for women. They have a medically patented technology for that. First in the world, we understand. Those things are selling very well, and they're pretty recession-proof because people will pay for that in any environment. Similarly to Arnaud on the Europe Fund, we've bifurcated our consumer exposure, Simon, to give us a little bit of exposure for those who do want to trade down. We have a couple of discount stores in the fund, and I hope this will make you laugh. We have a stock called Don Quixote. Thank you for that.
Love it.
It's in fact, there's one right next to my house, and it's open 24 hours. And if you want to buy anything, if you want to buy cornflakes, if you want to buy a printer toner, if you want to buy shoes, if you want to buy a television, you could probably go and buy it at Don Quixote because they sell almost everything at a great price. And they, as I said, also they're discounted. They benefit from periods of slightly weaker consumer spending. They're also just an engaging, entertaining place to shop. And those two ends of the consumer spectrum that we have in the fund, the more luxury areas like Kose with its cosmetics, the slightly more consumer sensitive, price sensitive areas like Don Quixote, they work quite well in the consumer environment we have in Japan.
Yeah, fantastic, Richard. Rick, anything you wanted to add? Global perspective on the consumer out there?
Yeah, so in addition to Arnaud and Richard, I think Team Global, what we have is we're spoiled for choice. So we certainly do have luxury players that we can play into. We have discount players as well. HDFC, which I mentioned earlier, so they're the leading Indian mortgage provider. They just posted up their last quarter, and they had 20% growth in the mortgages that they have under management. So obviously, in a world with inflation, potential recession, and so on, they're doing just fine. They operate to a different cycle to the rest of the companies in our universe. India's gone through over 10 years of a cyclical downturn. Inventory is now cheap. Policy is accommodative. The structural growth trends are still very much in place. So even as the rest of the world is going down a route where it looks like the consumer is going to be more and more pressured, that part of the the market in India is still doing very, very well. And then the other example I would point out is also Costco. So one you guys would obviously be very familiar with, but at the start of the podcast, I highlighted that quite often when you get these macro shocks you get the opportunity to buy a great company. Costco, they make most of their profit from their membership stream. It's generally very resilient. It's quite resilient, and yet the shortcut that the market tends to take is that it's a bond. So in April 2021, when bond yields finally started rising, the shortcut for the market was, let's sell out of this name. And yet we said the valuation is there. We're probably going to get a price increase in the next 5 years. It's going to resonate even more with the consumer. So we got to buy that one at a very good valuation, as the market was concerned about bond yields, but it was completely dislocated to where that fundamental valuation should be.
Fantastic. Just to recap a couple of the fantastic names that were mentioned by the team. Arnaud mentioned Ferrari and H&M. It's kind of the both sides of the spectrum that you can invest in, the high premium or the discounted side. Richard mentioned Cosserat and Don Quixote as the Asian consumer. And then Rick also just mentioned HDFC and Costco, all great ideas from the retail perspective. One last topic that I wanted to chat about was what you just mentioned, Rick, was valuation. You know, this has been such an interesting time because we've seen the multiples of so many companies reset in 2022. They're much lower in terms of whatever metric you want to look at for most companies than they were a year ago. Certainly, we've gone from a euphoric market to a non-euphoric market here today. But for you all, gentlemen, as you're allocating capital and you have client assets, how do you think about allocation and valuation? Are you looking at historic multiples? Are you discounting cash flows back? A blend of both of those? How do you think about when is the right time to buy a company from a valuation perspective? Arnaud, let's start with you on this one.
All right. You know, valuation, I always answer, I mean, valuation is always dependent on your investment horizon. If it's 6 months, you know, anything is possible. P can go up or down. Nobody knows. If it's 5 years or 10 years, which is where we invest, yes, that makes sense to think about the P. And usually when you're investing in a company that deliver 10% in a very sustainable manner over the next per annum over the next 5 years, most of the time they are undervalued. Most of the time, sustainability is overlooked by the market because the market is very short-term by nature. It's very myopic, and they don't try to think about in terms of sustainability. And where we differentiate is by focusing on sustainability. The most extreme example I would give you is there is a company we've held in the portfolio on Europe. There is a world leader in computer-aided design and computer-aided manufacturing. It's called Dassault Systèmes. We've held it. It was IPO'd in 1996. We've held it for more than 20 years in the last 26-7 years of listing. And there was a time at the TMT bubble, remember, in the early 2000s, and then suddenly the price went up to 105 times earnings. We had sold at 60 times earnings because we're not. I mean, 60 times earnings means you're looking beyond the next 5 years. You're looking at 10 or 20 years. The thing is, if you had been a dumb investor and you had bought at 105 times earnings in March 2000, you'd be better off today than investing in the market. The stock delivered twice the return of the market over the next 20 years. So not great returns. I mean, we're talking about 6-7% against 3% of the market, but still. Meaning that if you have a great company, you know, it's a matter of time horizon. So we don't pretend we're able to predict the next 20 years. We focus on the next 5 years, and if possible, the next 10, which is already a lot. And usually we're more valuation tolerant than the market in general. So at the moment, I would say with the correction of the growth companies, not the quality company, but the growth companies have corrected a lot in the last 3 years. I think there is a lot of money to be made. I think we have interesting opportunities. I mean, remember, it's the first time we've seen I think it happened 3 times in the last century, where the 3 major markets, which are equity markets, government bonds, and corporate bonds, are down altogether by close to 15-20%. Only happened 3 times in 100 years. So there was no place to hide. Even the bitcoins, 65% down. no more a safe haven. Incredible. So I think it's a good moment to invest. I mean, I would recall the words of Warren Buffett. You know, you need to be greedy when the market is ahead of itself and opportunity, hopeful when it's a bit pessimistic.
That's fantastic. I love that quote, Arnaud. Sustainability is overlooked by the market for most of the time. That's one that we should be putting on our refrigerator as investors. Fantastic words of wisdom. Richard, any other thoughts on valuation, how you're allocating right now?
Yeah, so certainly we run a game plan. So every stock that we follow closely on that buy list, we certainly have run a recessionary scenario. They are all names that we would love to buy. A couple of months ago, we were very close to the trigger levels. We call it the back the truck up levels, where we feel like here is a phenomenal company that we would love to own for the long term. And we're finally coming close to the point where the valuation might actually make sense, kind of similar to the points about dislocation we were talking about. So in one sense, the market feels very vulnerable, very pessimistic, and yet we're cautiously optimistic because these are the times we get to secure that future alpha. We do get the question a lot from our investors. So we did, everything for us is bottom up, but we do look at things from a top down level just to provide, our investors with a little bit of insight. We looked at the multiple of our portfolio over its 30+ year history. At the end of 21, the portfolio multiple was at 30 times, which was pretty much at the high end. At the low end, it's at 30 times.
30 times earnings? Is it times earnings?
Exactly.
Yep, got it. Okay.
12 months earnings. And then looking at the low end, it bottomed out at about 15 times. Today we're at 20 times. So very much it feels like it is skewed to the upside. Who's to say what's going to happen in the next year or so? That's certainly not where our edge is, but we feel, like the skew is maybe to the upside. And then on top of that, like we look at the forecasted earnings growth over the next 5 years for our portfolio, we're forecasting 13% earnings growth. So, even if we see that those 4 or 5 points of multiple compression, we would need to really underperform on that forecast earnings growth, which is, the product of our bottom-up process. We would have to deliver 4% earnings growth over that 5-year period in order to deliver a negative fundamental return. So valuation compression plus, earnings not playing out as we would expect it to. So certainly it is a theoretical exercise, but as I was saying before, it does feel skewed to the upside.
Fantastic. And maybe just one comment for anyone listening to the show, a reminder that you can make money in stocks in generally 3 ways. One, fundamental growth. The earnings are higher this year and next year than they were the previous years. 2, the valuation expands rather than contracts. The market is willing to pay a larger multiple today than it would be yesterday. Or 3, dividends. We haven't chatted a whole lot about dividends, but that's the 3rd way you can make money in the stocks as well. Richard, how about in any context on Southeast Asia? Our valuation multiple is also contracting there. You said that inflation is a little bit tamer in Japan. It is,
Yeah, sure. Inflation is tamer in Japan, but the interesting thing in your question, Simon, is that if you were an alien from space looking at the Japanese market, if aliens from space look at this kind of thing, they would probably think it's pretty much like the US market. Why? Because we've had this rotation to what some people call value stocks. We've had this rotation to banks, to oil companies, to energy companies, which are all premised on the idea ultimately of inflation. So even though we don't have inflation, the things that should be responding to inflation actually have gone up in this market. And of course, I think that's wrong because of what we said earlier about not really having inflation that is the premise for share prices to go up. Also, the effect on valuation is that we've had a significant compression in the valuation of companies which are still doing a great job. We have some companies which have been growing at more than 20% through the last few years. Throw COVID at them, take COVID away from them, throw a global recession, throw a global war at them. They're still growing at 20% plus. I'm talking about some of our little internet companies that are offering unique services. But those things have seen a multiple compression, in some cases of 70%. And you can't explain that except by talking about this this fake inflation idea that some people have had in Japan, which I think again is simply a replication of patterns they've seen in the US market, which they're imposing on Japan. So yes, multiple compression has been a big problem. It's been driven by a mistaken understanding of our economy here in Japan, of our market, and of course the opportunity is massive. We're seeing a 19, to throw a few last numbers out there, and then I'll round up on this one, Simon. We have a 19% earnings growth for our companies this year. The premium we have to the market here is the lowest we've had in 15 years. The market here in Japan, don't let me mince my words, is full of a lot of dinosaur companies that don't cover their cost of capital, don't respect investors. A lot of them are very cheap, and they should be. But our premium to those is the smallest we've had in 15 years, and we're growing at 19%. We see a 17% earnings growth for the next 5 years. We're pretty sure about those numbers. So yes, the opportunity for us, we think, is screaming, and we're not sitting still with that. We're adding to the companies that have fallen most.
Yeah, fantastic. Maybe in the last segment that I'd like to chat about, it seems like a year and a half ago there was so much euphoria in the market, right? Do you guys remember in February of 2021 when the dumb ape NFTs, were selling for millions of dollars, and everyone was coming public with a SPAC, a special purpose acquisition company, and just valuations were through the roof. And just here today, we are in completely the opposite. We've gone 180 degrees the opposite direction now. Now 1 in 5 Americans are closing down their investing brokerage because they're just terrified to invest in the stock market. Certainly everyone on this call knows that, or I believe all of us know or would assume on this call, that that's a mistake, that investing is a long-term endeavor. You can invest in good markets or in bad markets or inflationary markets or NFT markets. There is always opportunities that are out there globally. Arnaud, I would like to start with you on just kind of the final thoughts for investors today. Where do we stand as stock market investors, and what would be something you'd like to pass along to our audience of individual investors who love to invest in growth stories, just like the companies that you're investing in? What's something you'd like to tell them today about the state of the market?
I think they need to separate the wheat from the chaff. They need to be very conscious about that growth is not sustainable growth. That quality is the main difference. When you invest, it's about risk. It's about risk first, and that means yes, there was a lot of extreme in the last 2 to 3 years around pure growth, high flyers. Many companies didn't make any money, zero margins, negative cash flows, growing like crazy, mostly financed by rounds of private equity, etc. But it was a bit blind. There was blind faith in growth. I think, and that's where we differentiate on the market. We always put quality first. So our approach is like growth, not at any quality. And when we invest in companies, we want to see how they monetize their opportunities, how it transfer into strong and sustainable margins for the investors in the end. And that's quality. And the quality is about a lot of things, but it's about a proven way to monetize their business and to make money for the stakeholders and for the shareholders. And so that's why I think the main message would be make sure you have some visibility as to when a company is going to convert its opportunity into cash. And that's pay attention to the quality, to the risk of those companies, to how high the moats are, how unique the business models are, how unique their products, their brands, their IP are. And that's where you differentiate in the long run.
Yeah, fantastic. A fantastic reminder too that growth doesn't necessarily mean overvalued or unsustainable growth. There are plenty of great businesses growing sustainably that are still growth companies too. Rick, anything you'd like to add to that as well? Final thoughts for our listeners.
Yeah, I'd summarize it, with someone else's wisdom. It's that Warren Buffett quote, which is, in the short term, the market's a voting machine, and in the long term, it's a weighing machine. Having a very stable team that's followed these companies for decades, it certainly does make the job of weighing up those earnings and future prospects a lot easier. Richard in Japan, Arnaud and his team in Europe, having that partnership approach, not only with ourselves, but also with the companies we invest in. It means that we're able to speak to these companies in very candid terms, often at quite short notice. And I think having that, long tenure in this type of investing, it certainly does serve us well in being able to weigh up those earnings.
Yep. And Richard, I'll give you the last word. It's got to be near midnight over there in Tokyo for you. I'll let you close everything out.
Very grateful for that, and I'm very much going to copy my colleagues' comments, Simon. I wanted especially to pick up on the tail end of Rick's comments there. You have to trust the people you invest in. The people that are listening to your podcast now, they have a lot of opportunities with different stocks, with different funds, but you've got to trust the companies that are running, the people that are running those companies. Ultimately, it's a human business here. And if you're putting money with managers, you have to be able to trust the managers and trust that they trust the people who are running the companies that they invest in. Ultimately, that's what it all is when we're talking about the sustainability of these stories. Do you want to be with these people that you put your money with? And what we try to do on the ground in Japan, Arnaud in Europe, Rick, with all the companies you visit throughout the world, is actually meet the people, look them in the eye and say, do we trust these people? Are they doing something exciting? Is it hard to imitate? And we think that when the answer to that question is yes, we can be with those people for a long time. And that's been the basis. We've invested in Japan over 15 years. It's what Arnaud and Rick have done in their various geographies. And it's been quite a successful formula.
Absolutely. Well, once again, for everyone listening, Comgest, Comgest, again, a global asset management firm managing over $35 billion, offices all over the world. Thank you to Arnaud, to Rick, and to Richard. Gentlemen, it's really been a refreshing pleasure chatting with you today. I really appreciate you being part of our 7 Investing podcast.
Thank you very much, Simon.
And thanks everyone for tuning into this edition of our 7 Investing podcast, where it's our mission to empower you to invest in your future. We hope you have a wonderful week, and we'll see you next time. Arnaud,